This LOS is evaluate the impact of tax rate changes on a company's financial statement and ratios. Changes in income tax rates. The measurement of deferred tax assets and liabilities is based on current law, but if there are subsequent changes in tax laws or new income tax rates, existing deferred tax assets and liabilities must be adjusted for the effect of these changes. The resulting effects of the changes are also included in determining accounting profit in the period of the change. When income tax rates change, the deferred tax assets and liabilities are adjusted to the new tax rate. If income tax rates increase, deferred taxes, that is, the deferred tax assets and liabilities, will also increase. Likewise, if deferred tax rates decrease, deferred taxes will decrease. A decrease in tax rates decreases deferred tax liabilities, which reduces future tax payments to the taxing authorities. A decrease in tax rates will also decrease deferred tax assets, which reduces their value towards the offset of future tax payments to the taxing authorities. So we've seen this in a previous LOS, this exact same table, where we had the equipment value for accounting purposes in 2004, 2005, and 2006, and we had the equipment value for tax purposes. And we could see in this case that the accounting on the financial statements, the net book value or the carrying value, is greater than the tax return, which led to a deferred tax liability, correct? Because we're using a more accelerated depreciation on our tax returns, so the book value of the asset on the tax returns is going to be lower. So here we had the difference, okay? So in calculating the deferred tax liability, and in this example that we looked at before, it was a 30% tax rate. So we take the difference and we multiply it by the tax rate and we get the deferred tax liability. So there in 2004, the difference was 857 times 0.3. You've got the deferred tax liability. Now, when we change the tax rate, so we're using that same example. It may be familiar with you if you've seen that video on that LOS. So for this illustration, assume the taxing authority has changed the income tax rate now to 25% for 2006. Although the difference between the carrying amount and the tax base of the depreciable assets are the same, the deferred tax liability for 2006 will be £643 instead of £771, which is a reduction of $128 in the liability because the tax rate went down from 30% to 25%. So here you can see there's no change to the carrying amount of the assets with regards to accounting purposes or on the tax return. There's no change to the difference, but what we're doing here is we're taking our 2571 and multiplying it by the 25%, and our deferred tax liability has gone down to 643. So it's pretty easy. We've been through this type of calculation before in terms of calculating the deferred tax liability, so it shouldn't be new to you. So now you're just applying a new rate. So I'll finish this LOS with a practice question. A company purchased a $2 billion long-term asset in 2009 when the corporate rate was 30%. Then they're giving us the asset at the year end in euros millions. For 2009, accounting purposes, 1,900. For tax purposes, 1,600. For 2010, the base for accounting purposes, 1,800. And for tax purposes, 1,280. On January 15th, 2010, the government lowered the corporate tax rate to 25% and for 2010 and beyond. The deferred tax liability as at 31st December 2010 is closest to A, 130, B, 156, or C, 205. Okay, this question ends up being really easy. All we need to do is look at the difference between the carrying value for the accounting purposes and carrying value for the tax purposes, 1,800 minus 1,280, that equals 520. And we multiply it by the new tax rate, 25%, so we get the correct answer, which is A, 130. So there was nothing that we needed with regards to the original tax rate. Again, we're just looking at the difference between the carrying values for accounting purposes and tax purposes. Again, accounting purpose higher than the tax purpose, so that's a deferred tax liability, but they're telling you that right here in the question anyhow. And so you're just looking at the difference times the tax rate. Very easy question to finish this LOS on. Thank you.